Now, of course, you're going to ask me, okay, fine, this is all great, but what kind of jobs can I do after learning this? And well, very simple. One, we start with investment banking, and with investment banking, I'm looking at companies like there are two kinds of investment banks. There's the bulge bracket investment bank, and there is the boutique investment bank. The bulge bracket investment bank is much larger, and if I was in class with you, I'd be asking you to name some, but I'll do that myself now. So the bulge bracket investment bank would be something like a Goldman Sachs, it would be a JP Morgan, it would even be an Edelweiss, because Edelweiss is now considered a bulge bracket investment bank. Bulge brackets generally have products across the gamut, right? So they do everything from M&A to IPOs to research, trading, sales. Okay, that would be, and of course a lot of other stuff like private equity, etc. But these are, let's say, the 5 fingers of an investment bank. Okay, a boutique investment bank like an Avendus, a May, a Lazard, a Rothschild would focus primarily on M&A and of course fundraising as well. So helping a company, a growth company, raise private equity. For instance, so if to give you an example, if Flipkart wants to raise another round of funding, they would go to a bank like ICICI Securities or Morgan Stanley, or even an Avendus and say, help me raise my next round of funding. That is an investment banking activity. But if a company wants to go IPO, that's also fundraising. They would go back to the same teams, but a team, something like Avendus, would not have an IPO arm. They would not be able to run an IPO. They would go to somebody like an ICICI Securities. That is also fundraising. Investment banking is also, they have it. So everywhere in investment banking, across these 5, especially M&A and equity research and equity capital markets, you need financial modeling. And we've gone into the details of why you need it in equity research, etc. If you go further on into equity research and credit research, all research requires modeling because you need, even if you're, be it if you're doing a country, so if you're credit research and you're doing country research and you're trying to understand the viability of India, you have to model out the viability of India. You have to model out India's balance of payments. You have to model out India's GDP growth. You have to model out what imports am I having, what exports am I having, are they going to change over a period of time. I have to model out my FX. I have to model out my bonds, the government bonds that we have. How robust are my government bonds? All of that is financial modeling. And when I'm looking at equity, I'm also, there's something missing here. I'm also looking at commodities research, right? So let's take oil. One of the most well-paid jobs in the world is something at Castrol. If you are a trader at Castrol, you're going to have a very robust model called, and we call it crystal ball forecasting, of oil prices. How are oil prices going up? How are oil prices going down? It's very complex. If you're in foreign exchange, you're going to have to model out foreign exchange over the next 10, 15, 20, 30 years even. If you are in a think tank in research, you're going to be modeling. Okay, so what would a think tank do? A think tank would look at the big questions. Big questions is, where is the world economy going to be in 100 years? A think tank is going to be asking questions like, how much will natural gas, how are we going to, will solar power, when will solar power replace shale, right? When will we replace fossil fuel? Okay, that's kind of big, although very complex models. So a model can then run to so M&A, your little chart shop might have 6 sheets. A think tank might have 600 sheets. Okay, but still modeling. Project finance, very simple. We just discussed this. Project structuring, project monitoring, risk analysis, debt, quasi-debt. So if you're working for a company like IDBI, if you're working for Asian Development Bank, if you're working for the IFC, you're going to be doing financial modeling. Finally, consulting, very simple. If you're working for McKinsey, KPMG, PwC, a small, one of the small consulting company right down your road, everybody's going to be using financial modeling. Okay, so again, this is where we need to stress that financial modeling is a skill set, right? It is something you go away. It is been considered by at least 80% of our testimonials post our courses in FMVC and an erstwhile program we used to run called IFAP, and the diploma in corporate finance, is that they have never learned financial modeling until they come to us, because financial modeling is it takes a little bit of time to learn. So this is a skill set that is very, very important. Moving on, what are the pillars of financial modeling? So because it's a skill set, you're not being taught a subject, and which is why what happens with most programs, be it your CA or your CFA or even an MBA, is that they give you all, and they do a great job of giving you the base data. They give you the accounting, which you need to know. They give you the forecasting, the valuation, but there you need to have a certain amount of very specific fundamental knowledge before you can actually model anything out. One of that is accounting. You need to understand how the P&L, the balance sheet, and the cash flow link up. And not just link up in that, okay, I know that what the COGS are, I know what EBIT is. You need to be able to understand that modeling out COGS is very different from modeling out something like an SG&A. So modeling out variable costs like raw materials, direct labor, which are variable, are very different from modeling out rent. And the problem is when you are a CA or a CFA, you are not taught how to model these things out properly, because you don't have time. You have to do it a couple of times to be able to model them out, because a linear cost like raw materials is much easier than a step cost like rent. And when you're modeling out something like rent, you might need to use a spinner, and we will discuss this a little bit later about the details of the kind of stuff we teach you. But a spinner essentially is a technique in modeling that helps you model out a step cost. Because modeling out a variable is very easy, right? So if I use 2 bags of cement for one wall, for 2 walls I use 4 bags of cement. But what happens when four people are required to make 1 wall, 5 people are required to make 10 walls, etc.? Then how do you model that out? You need to use spinners. But accounting is not just that. You also need to understand balance sheet. You need to understand the linkages between how to value out depreciation. We primarily use straight line depreciation, but how do you model out straight line depreciation? What do you do with capital work in progress? Now, if any of you are CAs, you obviously know what capital work in progress is, but do you know how to model out capital work in progress? Do you know how to model out deferred taxes? Do you know that you shouldn't touch the investments? Because essentially modeling out accounting means that you have to be very careful about your linkages, right? The second fundamental pillar that you need to know before you model out is the ability to forecast, and this is what we were talking about, which is essentially accounting. How do you forecast a step cost? One is modeling it out using a spinner, but how do you actually forecast? How do you forecast industry growth? So, for instance, if I am making pencils, I'm a pencil maker. How am I going to know how many pencils are going to be sold next year? And we teach you that. We teach you how to forecast the number of pencils. We teach you top-down forecasting and bottom-up forecasting, right? And so once you forecasted that out, how are you going to forecast the costs? Again, we go back to linear and step. How are you going to forecast working capital? And for this, that means you need to understand ratios, working capital ratios, extremely well to be able to use them to forecast. Finally, of course, we get to valuation. So you've done the accounting, which means you know how to build out the P&L balance sheet and the cash flow. You've been able to forecast the P&L balance sheet and the cash flow. We then need to understand how to value. And from financial modeling perspective, of course, we're always modeling cash flows. Okay, we're always forecasting cash flows, but that's not the only thing we're forecasting. And so, for instance, we go into valuation, we'll try to go into it later, but you need to understand the two basic ways to model to value: income-based valuation and market-based valuation, and both of them are used in financial model. So you need to be fairly strong in your valuation. You need to be strong in DCF theory. You need to be strong in market valuation theory to be able to forecast. Modeling assumptions. So the first three are what I call the fundamental knowledge pillars. Number 4 and number 5 are techniques. They are what you call the actual doing of the modeling. How do you model out assumptions? And this is very simple. So if I am going to say that and modeling assumptions is something like we're talking about chai, right? So if I'm going to sell 100 cups of chai today, I think it's going to go up by 15%. So I'm going to sell 115 cups of chai tomorrow. The 15% is the delta that I model in. Now there are two ways to model this, right? So if you are not been taught how to model, you will essentially do what? You will say one cell equals 100 times 15% plus bracket, close brackets, plus 100, correct? Which will give you 115. That is not modeling. That's just math. Modeling is when I take the 15% and I model it in. So I am giving one of you the ability to look at my model and say the 15% can be changed to 20%, thereby changing my entire model. I will then bring that down, my entire model will change. What all will change? That's accounting. Everything changes. My sales changes, therefore my cost changes, therefore my profit margin changes, then my retained earnings change. If my retained earnings changes, my cash inflow changes. My retained earnings, my cash inflow changes, my valuation changes. Okay? So that makes my model robust. But if you don't give me that cell and you give me something in a formula, I have no idea what's going on. How on earth did 100 get to 115? That is not a model. Which brings us to the art of modeling. The art of modeling, a good model in investment banking, means that you know how to color code, which means you know how to use fins. You know how to make it complex enough that you have line items, but not too complex that it messes up with your linkages. So you don't want to have a terribly simple model, but you don't want to have a very complex model. Remember that forecasting and financial modeling, you're always going to be wrong. Because forecasting, you're going to be wrong almost always. What we're trying to do is mitigate how wrong we're going to be by actually making a model. Okay, so I won't sell 115 cups of chai tomorrow, but I know that I am ready to sell 115 cups of chai tomorrow, and that's what a model does to me. If I sell 120, at least I had enough for 115. Okay, but if I don't make a model at all, I won't have 115 at all. So we're always going to mitigate risk in modeling, and to mitigate risk in modeling, you need to have robust documenting your assumptions. So you can't have very few assumptions because then the model will not work, and you can't have very many because then the model will be too complicated and you make a lot of mistakes. Okay. Of course, now what is the kind of stuff? So this is a small example of what the kind of thing we teach you in one class. We will basically take you through how to create the base model. We'll tell you gather historical data, put them into I will start with, and I'll sit and do this with you. I'll essentially say, okay, take your actual data, historical 3 years accounts, restate the data here, leave a column, restate another data, leave a column. We also teach you how to restate data. Why do we want to restate data? Because we want to make the data work for us. It's our model. And I want to make sure the line items are what I want to focus on because I know the business, okay? 2, we have to develop a likely economic industry scenario. Therefore, we teach you industry analysis, which means what? Very simple. At a very base level, we teach you how to do the quotas and apply it to a model. We also teach you how to do economics. So we teach you we teach you basic economics, basic economics that will be helpful from understanding GDP to understanding foreign exchange. We then go in and teach you how to forecast sales, okay? And finally, we go in, we forecast the non-sales remaining items. We go one by one. Forecasting P&L is very different from forecasting a balance sheet. As we talked about, then we of course teach you how to determine value. And then we finally finalize your reports and help you support your decision using the documented assumptions that you have in your model. Okay, do you have any questions until now before we get into Where is that? Sorry, just a second. No questions. Should I?
If you guys have any questions, we'd request you to drop them in the question box. It's on the right-hand side of your screen. Thanks.
Again, what do we? What's some of the details we go into valuation? Of course, here I'm talking about three. We use comparative ratios, comparables, discounted cash flow. Something very important that we understand is we often have to work very hard. Most people come in, they do not know how to do a DCF, even if they've done an MBA. Why is that? Because they don't know how to forecast cash flows. Why is that? Because they don't know how to model out a business, right? So if you don't do a DCF, if you don't forecast cash flows and do a DCF, you can't actually model anything. Because even if you want to use comparative ratios, you need to be able to model out what my cash flows are going to be over the next few years. Okay, comparable ratios and comparative transaction comparables are also used. We also model those in to create a complete financial package that we can give to an investor. An equity research model would have a number of pages which will end in valuation. The valuation pages will be comparable transactions, comparable multiples, EBITDAs across the industry, EBIT across the industry, that will finally help them come to an understanding of comparable valuation. What are comparable valuations? To quickly go into it, is essentially we're trying to understand if I am a chai shop, but there is a listed chai shop, and I make a 10 rupees pat. That company makes 100 rupees pat, okay? And its market value, market cap is 1,000. What's the multiple? It's 10, right? So we will say that because it's a chai shop and I'm a chai shop, I will apply the 10 to mine and get a valuation and a value of 100, right? So that would be my equity valuation, correct? We will model in that kind of stuff, and we try and understand how that works. Of course, we're talking about what discounted cash flow is. It is the foundation for all valuation approaches. Again, it's just what I discussed over there. We take the intrinsic value of any asset based on what cash flow is expected to generate. But of course, that depends on that also depends on valuing that out and modeling that out in the future. What terminal rate is, what terminal growth rate are you going to take, what terminal growth rate are you going to forecast, and etc. We will of course teach you the CAPM model. We will teach you the how to do a levered beta, how to do an unlevered beta, how to lever, unlever, use the CAPM model, come to a WACC using a cost of equity and cost of debt. Of course, going back into the principles of time value of money. Time value of money, of course, is very, very critical to DCF. We will also be teaching you about, and the time value of money is very important, even if I'm talking about IRR and project finance. So essentially, what we're going to be doing is teach you how to use the CAPM to basically value out in the future what the forecasted cash flows are going to be, and then we bring that back. Just to give you a question of what time value of money is, I think that's what the slide is trying to say, is it's essentially what is the value of 1 rupee today, 1 rupee in 10 years today, right? And how do we do that? We bring back money by discounting it. And the discount rate is very important. And the way we get that discount rate, we get the discount rate by WACC, a weighted average cost of capital. Weighted average cost of capital is broken into the cost of equity and the cost of debt. Cost of equity comes from the capital model, as I was just saying. The cost of debt comes from whatever the debt of the company is. When we go into that's the key thing that we go into to understand DCF. Why do we document? Now we go back. Why do we document assumptions? Very simple. Now that we've done valuation, we're now coming to documentation, the art of modeling. We document assumptions because if models are given to people to help explain the business, a model should be self-explanatory. Okay. So if I am saying that if I'm going from 100 cups of chai to 115 cups of chai, I should not be able to explain to you that I'm going up by 15%. That is a model, and it also helps me. it also, if I don't document my assumptions, I will also not know how I went wrong with if my forecasts are wrong. Okay, how will I know what assumptions I had initially if I don't document them? And of course, simply enough, it helps people change the 15% if they disagree. Going into the program, of course, we're going into certified. Now, I think again, I'm going to ask you if you have any questions, because now we're going to go into details about the actual program. So are there any questions? No?
Yeah.
No? Oh, you're not. Oh, okay. Okay. Do I type? Okay, fine.
From Rajeshri.
Okay, I have a question from Rajeshri Bose. How is a valuation certification going to help me if I'm a BCom graduate and a CA interqualified? Well, for one, as I said, the valuation certification is going to help you because it tells an employer you did not, a BCom degree does not tell an employer you know how to financially model, because you don't. Most people come out of the BCom not knowing how to model or how to value a company. A CA interqualified also does not get taught how to model. Okay, they don't get taught how to create a robust financial model, which is critical to jobs in investment banking, private equity, equity research, equity capital markets, across the board investment banking, financial consultancy. So, a valuation certification tells someone, one, you can pass the interview because they're going to ask you questions and we're going to help you. We're going to prep you for that. Two, it also is going to show the employer that you know how to do a very critical part of the job, that you know how to value a company, and that you know how to model out a business. I hope that helps. How is the Rahul T? How does financial modeling help investment banks to understand treasury bills? Very simple. It is cash flows. We help model out cash flows, and we also help understand the risk of a country. And a country's risk is determined by balance sheet, accounts, payments, etc., which will then impact the quality of its treasury bills. I hope that helps. So let's take, for instance, let's go back to, and this is a great way to give you. China, as you know, owns a lot of the U.S. debt, right? If you'd known in the recession, one of the great things that happened in the U.S., the global financial crisis, is that China was very close to actually dumping a lot of the US's treasury bills. Why would they do that, right? They would dump a US treasury bill if they think that the US is going to collapse. So somewhere in China, someone would have made a model that would have modeled out the collapse of the US economy. Can the US actually pay me back? When I call for this bill, will they actually be able to pay me? And the cash flows from the country's cash flows, the balance of payments, the interest rates, everything gets modeled in the GDP to know if the treasury bill is actually valid. What is the credit risk on the bill? Okay, so that's how that helps. But just to let you know, that's credit research. Okay, that is not equity research. We just have to be very clear. Credit research, it's financial modeling, but it's credit research financial. Okay. What is enterprise value? Okay, good question. Enterprise value is loosely translated as market capitalization plus debt minus cash. Why do we use enterprise value? Very simple. Enterprise value came in when, so what is market capitalization? So let's find out what equity value is. What is market capitalization? Market capitalization is very, very simple. It is my PAT number, the profitability I make, multiplied, okay? Profitability I make multiplied into the number of shares, okay? So the PAT is, so that gives me my market cap. Okay, now what the problem is that my enterprise, if my market cap includes PAT. It does not, my market cap also, if it's PAT, what's happening? It's coming after my interest cost. So market cap or equity value does not take in the impact of debt in value creation. Why is that important? It doesn't matter if there are two pencil makers and both the pencil makers have no debt, correct? Obviously, it doesn't matter, because the market cap of that company and the market cap of this company can be compared, because none of them have debt, and therefore that's not going to be impacted. It's all been funded by equity. Okay, but if you're a steel company, now one steel company, let's say Sale Steel will have large amounts of debt on its books, and something maybe a Mukund Steel might not have any debt on its books. Are they comparable? No, they're not comparable. Why are they not comparable? Because one pact has the impact of a large amount of debt, and another pact has the impact of no debt, which means the operational profit does not help you value, right? We don't know how much value is attributable to the debt and the equity component. The enterprise value helps us value the company's efficiency in creating profit. So we go above the PAT line to align to the EBITDA line. The EBITDA line means that both companies have not taken the impact of debt. So from an efficiency perspective, both those numbers are comparable. And that EBITDA number multiplied by an EBITDA multiple will give you the enterprise value, which includes debt minus cash. I hope that answers your question. Okay, a brief explanation for WACC. WACC is a weighted average cost of capital, which means what? Actually, let's go back to the question, the example that I was giving about the Sale Steel, right? One steel company has no debt, one company has debt. If a company is funded by both equity and debt, I cannot just discount the future cash flows by the cost of equity. I have to discount the future cash flows by also taking into consideration that the company is going to be funded by debt in the future. Therefore, I have a weighted average cost of debt, which takes into consideration that my cash flows in the future are going to be funded by a proportion of both equity and debt. A weighted average, and to go backwards, the weighted average cost of capital is divided into cost of debt, to debt to equity ratio, cost of equity to debt to equity ratio. Okay. Now the cost of equity is the CAPM model. We get it outside the CAPM model. The CAPM model is the CAPM model is the risk-free rate plus or minus plus the beta, which is the levered beta into the risk premium. Now and of course the cost of debt is the company's cost of debt, which when we don't know what the cost of debt of the company is, we generally tend to take the 12% so we take 8% to 9% for a big company like Reliance. We will take 12% for a medium company, and for a small company, we will take something as high as 16%. Okay, so a weighted average cost of capital is a discount rate that you use in when you discount for DCF. All right. Again, it's the same answer that I gave Rajshri Bose. It's great. You're CFA level 2. Congratulations on passing your CFA level 1. The CFA is a great course. Okay, the CFA helps you gain the pillars. We're talking about the pillars: accounting, valuation. Unfortunately, even the CFA doesn't do a very good job on forecasting. It does a great job on accounting and valuation, but it does not teach you how to model. Okay, simply because it's a self-study program. Nobody's coming and telling you, build me the financial model of a chai shop. Build me the financial model of a steel company. Nobody's teaching you how to forecast the sales and the cost of a steel company, or a pharma company, or a startup, or an e-commerce company like Flipkart. A CFA doesn't do that, because the CFA is about learning, and it's great at that. It's about academics. It's about learning the theory. A CFM is about applying the theory you have learned to something that can help you in your job. It can help you in M&A by helping you value companies. It can help you in equity research by helping you value a company knowing whether to buy or sell or hold the company. Understood? So essentially, the CFM is a role-specific, job-specific course that teaches you a skill. The CFA is essentially a program that gives you knowledge, and it's a great knowledge. It will tell the employer this person is a dedicated person, can work very hard, but I don't know that person can actually make a model, because you don't make a model in the CFM. Okay? What can I learn in the CFM from? The next question is, what can I learn in the CFM from Rahul T? That's exactly what we're going to cover right now. So this is what I'm going to. Yeah. The CFM is an 8-week course that focuses primarily on modeling. Okay, financial modeling to be exact, using the pillars that I was talking about, which means that week 1 we spend time on understanding accounting. We understand the financial statements, but in an Excel sheet. You'll be surprised how many people don't know what a balance sheet and a P&L looks like on an Excel sheet. They know what it looks like in an annual report, but they don't actually know how to link things up. We will teach you how to link that up, the balance sheet, the income statement, and the cash flow. So we will teach you basic overview of the financial statements. We will help you. Oh, this. Okay. So, okay. So for instance, here are the key ratios. We will talk to you about what ratios are important. So when I was talking to you about, about the how to model out working capital, we will teach you obviously about liquidity ratios. We will teach you about efficiency ratios. How ratios are critical for trend analysis. Trend analysis is critical for forecasting the future, because if you don't know the past, and we only can study the past using ratios. We study the past, create a trend analysis, and then we do something called the percentage of sales method using the ratio. Okay. In week 2, we go into details on how you model out specifics. How do you model out sales? How do you model out cash expenses? What is the difference between the linear costs, and what is the difference between a step cost? In a step cost, how do we use the spinner to actually model out the step cost? Okay, what is a spinner? Okay, very simple. A spinner is something we use in Excel that will essentially, like, I don't know if people have come in later. People have come in later on, but essentially the spinner is, it helps you do. What is a step cost? The step cost is, we need to move to a bigger office every time a bigger call center, every time I add 20 people. That is a step cost, right? That's not variable. A spinner helps me model that out I'm able to say that every time I add sales of over this many, I need to essentially add in this many people automatically, which will then automatically add in rent. Okay, so that's a spinner. We then model out capex and depreciation. We will teach you how to model out capital work in progress. We will tell you how to do a fixed asset schedule, which nobody knows coming in. Okay, a fixed asset schedule is what is required when you actually model out an entire business of a company. We model out debt and interest payments, current and deferred tax, just like we discussed. Obviously, in week 3, we focus on modeling working capital, which means, are we going to use days outstanding for forecasting working capital, or are we going to use percentage of cost, percentage of revenue, or are we going to use both? How do we get to net working capital? And we also then try and understand later on how this impacts valuation, because you'll be surprised at how important working capital is in valuation. Okay. Obviously, in week 4, now you know how to link the 3. You know how to link the P&L, balance sheet, and cash flow. You know how to you understand that it's important to red code what the difference between hard coding and derivative cells are. Hard coding needs to be in a different color. We will ensure that you know what level of detail you need to go into each line item. So if you're modeling out sales, you can't just say the number of chai you can't just say that revenue of a chai shop goes from 100 rupees to 150 rupees. How does it go from 150 rupees to 150 rupees? What are the line items? And what is 100 rupees made of? 100 rupees is made of price times quantity, which means you need to model out price and you need to model out quantity. But then, how do you know what the price of chai is going to be tomorrow? which means then you need to do industry analysis. You need to actually go into the team to understand the ecosystem of the chai business, right? How do you model out? So we then teach you how to do top-down forecasting and bottom-up forecasting. And the best way to do that is in a real-life case study, which we sit with you and we help you understand a business from start to finish, and you build out a model. Every cell is taught by us. Okay. Once you do that and you have your model, that you've got the base model ready. What do we do with that base model? We teach you how to forecast. We teach you valuation, because we assume that you don't know, or we assume that you have base knowledge, so we don't know knowledge of valuation. So we go through the basic approaches to valuation. We teach you about income-based valuation, market-based valuation, detailed understanding of the DCF, detailed understanding on the sensitivity analysis, so that you know the theory before you actually test it out. We also, to ensure that you have a certain amount of role specificity to the CFM, we focus a little bit on M&A and private equity. For instance, how will you actually value a startup? How will you actually, what if tomorrow, if Flipkart bought Myntra, what kind of model would they have used to buy Myntra? How would they have valued out synergies? Okay, what are the valuation challenges in M&A? What are the valuation challenges in financial modeling? How do you invest in a company? How do you make a model for private equity? How do you understand exits? Okay, and that next brings us to very specific models. We will also teach you project finance models as well. So how do you do a cash flow waterfall? And also, how do you model out an LBO? What is an LBO? An LBO is when a company uses debt, when the company borrows on the company they're buying, the cash flows of the company they're buying, but then you have an entirely different model that you need to model out, because suddenly the company that you're buying will have debt on its balance sheet. And that will make a huge difference to what it was valued in the first place. How do you do a leverage buyout model? We also teach you on what are exits. If Flipkart buying Myntra will have a very different valuation model to Sequoia putting in money into Myntra or into Flipkart, because Sequoia is going to get out in 5 years. Flipkart is not going to get out of Myntra in 5 years. That's a whole different model. We then have to understand what is the valuation at exit. How do you model valuation at exit? Understood? All of this, of course, and of course, the project finance we will obviously also teach you how to value a project. Okay, how to model out a project. So let's say tomorrow you want to just do a ceiling. How do you value out ceilings? How do you model out a project finance project? How do you value that using IRR and cash flow? And of course, week 8. Through your journey in the 7 weeks, obviously you're going to be able to learn Excel, right? Excel is a base. Excel is how we teach this program. But in the final week, we will also teach you Excel best practices. How do you color code? How do you use conditional formatting in a model? How do you actually use the spinners? How do you use VLOOKUP, goal seek? How do you use conditional and nested if functions? How do you make a pivot table? Okay. Waterfall charts, football feeds for valuation. And these are critical. And again, this brings me to 2 of the questions that are there. Where are the questions? 2 of the questions that I see from one Krishna Shukla. How is it different from diploma? How is it different from the diploma in corporate finance? Okay, we'll hold that for now. I just want to discuss the what can I learn? Why is the CFM program different from the MBA? The CFM program is different from the MBA. For the basic one, the MBA will take you a year. The CFM program takes you 8 weeks. 2, it's based on Excel. Okay. I don't know an MBA program that will teach you football fields or waterfall charts or how to make pivot tables or VLOOKUP or how to actually model something out holding your hand. That's the key. The CFM program is a job skill building program. The MBA is a multidisciplinary theoretical program. Okay, that's an academic program, multidisciplinary academic program. This is a professional program that teaches you how to do a skill, which will be useful to get a job. That's the key difference, okay? How is it, Krishna Shukla, how is it different from the Diploma in Corporate Finance program? The Diploma in Corporate Finance program, if I'm not mistaken, is 6 months. It's a longer program. It's a diploma program, okay? Essentially, what that means is we go into a lot more detail, okay? It's not as long as an MBA. It will have all of these. One, it's not, the CFM program is online. The diploma for corporate finance program is not an online program. It's a blended program, so you have to come to classes. Two, it's a longer program. But yes, a large part of this would be taught in that program, but you have to come to classes and it's not online. This is shorter. It's very, very specifically designed for modeling and valuation. Okay?
So we also have a question
Joy will
from
take this up.
Suhas. Yeah, Suhas. Hi, this is Joy here. So your question is whether there's anything more than just the hours that you learn in the class, right? So again, this is a just right 8-week program where we do these classes every Saturdays and Sundays for 3 hours each, which is about 6 hours per weekend, and we do this every single week for 2 months, which takes you to 48 hours. And we've given you like the detailed curriculum that we capture week on week, and that's how we basically complete this program across a 2-month period. In this addition to like these live classes that you basically undertake online, we also give you a lot of content in the form of PDF, these reading materials. We also give you these quizzes that you can undertake on the LMS itself. So, I mean, as soon as you register, you get access to our LMS, that's the Learning Management System. So I think what we'll do right now is we'll just quickly release one poll. We have a few questions. We have actually got a couple of them that we would like to ask you. So I'm going to go launch a poll right away. And I would request all of you to just answer this question quickly, and that'll be helpful because once we have this in, then we'll accordingly get back to you.
Hi. So I will take the first from Rajri Bose. 1 second, Rajri. Yeah, Rajri Bose. I'm a CA final student as well. Will the program be of additional benefit to me? Absolutely. Again, the CA does not teach you how to model. It does not teach you how to forecast. So most people who come to, when I was at Avendus, analysts would come to me, CAs from MBAs, and they would not know how to link 3 sheets together and forecast a model. Okay, they would not know how to do line item forecasting. They did not know the difference on why modeling out rent or repairs would be different from modeling out direct labor. What do you do with indirect labor? How do you model that out? No idea how to model out capital work in progress. They had no idea how to balance statements for large. What are the main issues that lead to non-balance and an imbalanced balance sheet? Okay, so that's the kind of stuff this program teaches you. So on one end, yes, this program teaches you to have a skill. On the other end, this program is a certification that shows an employer that you have the skill. I cannot stress more importantly that how people invest banks, I do not hire if the person does not know how to doesn't know how to create a financial model. Financial modeling is 70% of a job in financial services. Okay, be it if you're in equity research, be it if you are in M&A, in corporate finance, you are on Excel and you are doing modeling. Okay, in fact, the way that somebody else asked the diploma is that if we talk to you presentation skills, here is primarily Excel, and we handhold for you. Like we tell you, this is what goes into this cell. Don't be afraid. Most people are very afraid of modeling because they look at a blank Excel sheet and they're like, oh my God, how do I create a forecast? How do I know what this company's sales is going to be next year? So that's the question I get. I tell them, but madam, how do we know how much chai they're going to drink tomorrow? That's what I teach you. I teach you how to do that. I teach you how to say, how much chai are you doing? There are methodologies. There are steps by which you learn how to know how much chai people are going to drink tomorrow and how to model that in to create a business model that helps say, do I want to buy this chai now? I hope that helps. How does the CFM program show to employer while in an interview, and which jobs can the CFM help me? I think Joy will take the first part of that question, but I will take the second part of the question.
Sure.
I'll just take the second part. The second, what jobs? The jobs are and this presentation has it. The jobs will be across the financial services, investment banking, primarily M&A, IPO, equity capital markets, venture capital and private equity. It will help you uh, uh, in equity research, become an equity research analyst. None of these jobs will hire you if you don't know how to model. But the great thing about this is also it is going to help you if you're an entrepreneur. Okay, it will help you if you want to join your friend's company as a startup, and you don't know how to model out the business. It's a basic skill, right? So even if you're not planning to go into investment banking, you're not planning to go into consultancy, you're not planning to go into private equity, even if you are planning to start your own company or join someone's company, knowing how to model will make you far more employable than the person who does not know how to model and it does not know how to forecast and it does not understand how to value or what leverage buyouts are. I hope that helps now.
Sure. Thanks, Reshma. So I'll just take the first half of the question where you speak about how. So I'll just in fact move to the next slide quickly, which also answers this question. Now, if you just go through the slide, right, there are like just three big elements that we do in terms of our career assistance services at Imarticus Learning. So, in addition to the 48 hours of like the classroom training that you will get online, apart from that, at the end of it, right, we also take you through a resume building activity where we help to refine and polish your resume using our templates. Now, what this does is, I think a lot of our CVs and our resumes look very identical to each other, right? Because we've probably not, gone taken the extra effort to go brush it down according to the requirements of that particular sector or that industry. So here, what we do is we have our own model resumes, and we go map yours against those. We go find out deviances, and then we help you to go bridge those. Then the other thing we do a lot is we help to actually go prepare for an interview. Now, I think this is extremely important because once we conduct these mock interviews with you, we also share the feedback with you, which is both right, as in it's both critical as well as if there are anything, if there are any good points in the interview, we also go share those with you. So you get as in you also get access to both like the pros and the cons of the interview. This again, I think, is extremely important because if you ask yourself, you don't really get any feedback from the interview that you undertake, right? Because you would either get the job or you don't, and in either case, very very seldom do you actually hear back from the interviewer on like, the feedback of how well you did or how well you did not do. So I think this is an activity that we conduct towards the end of the program, where we also go beef up like your resume, and then we conduct an interview with you. And then we also go share the feedback on this interview, so it helps to hone your strengths and address your weaknesses. And apart from this, the third thing we do is we also share like, leads and references of organizations who are looking to actively hire and absorb talent. Again, these are both from our private networks as well as our public sources, which are from job portals such as Naukri, as well as and also from LinkedIn. So if you have any more questions about like these just career assistance services, you can always reach out to us. Our email address is over there on the screen. It's elearning@imarticus.com. And of course, alternatively, you can also reach out to us on our All India toll-free number, which is also on your screen. I hope this answers your question with respect to how can this program help at the time of the interview that you would land up doing. So I think these three things, or like these three, are like your key areas where you get another value add over and above, of course, the program. We'll take another question if there is anything, and of course, if you have any ongoing questions, and if you have any questions for us later, you can always drop an email at elearning@imarticus.com, and we generally have a tendency to reply back in the next couple of hours or so. So we'll be happy to answer your questions right away. And of course, you can reach out to us directly. And I think a few of you, I think 80-85% of you have asked us to reach out to you. So we'll do that as well. But in case in the meanwhile you have any other questions or you would like to reach out to me directly, you can also reach out. You can also call the toll-free number.